Introduce Evolution. Jake Klein, Executive Chairman. As Australia's second largest gold producer, Evolution will be familiar to most of you. The company has operations across Queensland, Western Australia, and New South Wales. Currently produces more than 800,000 ounces of low-cost gold per year. Jake is an experienced mining executive who has overseen the growth of Evolution since its formation in 2011. And with that, over to Jake.
Thanks, David. Hard following a Wallaby. I was wondering if I should have put on my CV that I played for the Camps Bay High School first 15. But we lost every game, I think. And I'm definitely not mentioning underground rates of development because John may come back and hit me. But I think we're good at it as well. Thank you for staying. I appreciate it. The good news, and we're only on the first intro, and the good news is at this last presentation of the day, your first cold beer is only 30 minutes away. It is an absolute privilege and pleasure for me to be able to present at Diggers and Dealers again. Congratulations and thank you to Nick Georgetta, John Langford, and Suzanne Christie for once again organizing a world-class conference. I really think this is a superb conference. Rather than just run through our standard presentation, our corporate presentation, I thought I'd try and give you some perspective around the longer-term aspirations and ambitions we have at Evolution. So this is a quick snapshot of the company. You saw a lot of the snapshot in John's presentation as well. We started the journey some 7 years ago. At that time, we were a six-person company with no production and an enterprise value of around $50 million. Our only mineral asset was the Mount Carlton deposit in Queensland, and a feasibility study had just concluded that the development of the project would be uneconomic. Today, what seems like a short 7 years later, we find ourselves as the second largest ASX-listed gold company with a market capitalization of around $3.7 billion. We have a portfolio of 7 assets, all of them located in Australia. In the 12 months to June 30, 2017, our portfolio produced 844,000 ounces of gold at an all-in sustaining cost of 905 Australian dollars per ounce, or in US dollars, $683 per ounce. And for the 6th consecutive year, we met cost and production guidance. Today, we are a highly profitable, very low cost, high margin, dividend paying gold company. We are in fact amongst the lowest cost gold producers in the world. And it's fair to say that we have largely achieved what we initially set out to do, which was to build a globally relevant mid-tier Australian gold company. I do think that the renaissance that has occurred in the Australian gold sector is something that we in the industry can all be proud of. We are again demonstrating that Australia is a world-class mining destination. It is a place I often refer to as God's gift to miners. It is a vast, highly mineralized, underpopulated, mining-friendly country where the rule of law can be relied on. All this, I believe, means that there's plenty of opportunities ahead for us at Evolution and for other Australian gold producers. But I can't help but insert a word of caution. Unless we can demonstrate that we have learnt the lessons of the past cycles, we will end up in the same place, relegated to the investor sin bin after destroying shareholder value. Egidio Bianchini, the co-head of BMO Global Metals and Mining Group and a friend of many of ours here, but particularly of mine, cautioned the sector earlier this year when he was quoted as saying, "There is more capital than brains to deploy it." I hope that this time the miners have found that out. Let's take on the challenge of proving Egidio wrong. It is fair to say that the last 3 years in the sector have been relatively good. In US dollar terms, the US dollar gold price has traded largely in a range of $1,100 to $1,350 per ounce. The Australian gold industry has had a much better time. We have benefited enormously from the falling Australian dollar and declining costs. The number of times the word record was used in the recently released June quarterly reports of ASX-listed gold miners was unprecedented. The divestment of approximately 1/4 of Australia's gold production by international mining companies as they deleveraged their balance sheets over the past 5 years has undoubtedly been a one-off bonanza for Australian gold companies. It has resulted in an emerging breed of exciting, globally competitive, low-cost and cash-generating Australian mid-tiers. My sense is that this is still under-recognised by global investors, who have been slower than domestic institutions to recognise it, and herein I think lies an opportunity. But, and it's a second word of caution, and we're only on slide 6, it is also fair to say that the story for investors has not been so simple. This, frankly, is an ugly chart, and I think it's one we should all be embarrassed about. It shows the 3-year share price performance of the 20 stocks in our peer group, which we benchmark ourselves to measure our relative performance. It therefore consists of Evolution's closest domestic and offshore peers in terms of market capitalisation and annual production. And whilst I am pleased that Evolution is very near the top of this table, and I don't consider 3 years to be long term, the harsh reality is that even in a benign US dollar gold price environment and a favourable Australian dollar gold price environment, we, the gold industry, as a group, have had difficulty creating and delivering value consistently. In fact, 11 of the 20 in the group had negative shareholder returns over this period of 3 years. It is therefore probably not surprising that against this backdrop, many active fund managers are having real difficulty stemming the rise of passive ETFs. It is also largely the rationale behind what has shaped our core business strategy at Evolution. We want to build a gold company that prospers not only when the gold price is going up, but one that prospers through the cycle. Put simply, we want to build an enduring and sustainable business. So what does building a gold business that can prosper through the cycle really look like? And why has it proved so elusive to gold companies? If you look at the key characteristics that enduring sustainable gold companies have, those that have been successful over the long term, thriving when the gold price is rising and doing far more than just surviving when the gold price is falling, and for which investors are consistently willing to pay a premium for, companies like Africa's Randgold, Canada's Agnico Eagle, the following 5 key attributes appear to be crucial. And whilst I also recognize that Evolution does not yet consistently demonstrate all of these 5 key attributes, I am very confident that we are well on our way to achieving it. Firstly, they have high-quality assets that operate at low costs. And they all have at least one cornerstone asset that anchors the company with a long mine life and lowest quartile costs. Secondly, they consistently discover more ounces at their operations and at a minimum replace mining depletion, but often extend their already long mine lives. Thirdly, they consistently demonstrate financial discipline and have strong and uncomplicated balance sheets. Fourthly, they all seem to demonstrate resilience founded on a core people culture of belief and understanding of their company's purpose, vision, and values. And finally, and very importantly, they invest smartly. The holy grail of the resources industry is getting ourselves to a point where we are investing more on a counter-cyclical basis and returning more to investors on the upcycle. As you know, the resources industry does not have a great track record at this, mainly because you have to be bravely contrarian to succeed in this area. When the gold price is rising, investors are urging you on to grow and build bigger and bigger projects, and then in the down cycles, boards and management teams become so gripped by fear that they won't pursue anything growth-oriented. You don't have to have a long memory to find examples of this behavior. The growth amongst the 5 largest gold companies that was fueled by the run-up in the gold price between 2009 and peaked in 2011 was followed by write-downs totaling $65 billion. That is a staggering amount when you consider that the market capitalization of the world's largest gold company today is less than 20 billion US dollars. We've all seen this horror movie before, and we know how it ends. Every time the opportunity is squandered, and unfortunately, Agicio's comment proves correct. It is a cautionary tale, because I do believe that the Australian gold sector has an outstanding opportunity in front of it. For us at Evolution, a key part of the strategy is a relentless focus on improving the quality of our portfolio. When we think of quality, we think mainly of two metrics: cost of production and mine life, both of which I'm pleased to say we've been able to significantly improve over the past 2 to 3 years. When measured by cost of production, our portfolio now makes us one of the lowest cost gold producers in the world. And whilst our portfolio of assets now has an average reserve life of over 8 years, we would like to get to a point where each of our assets has at least an 8 to 10 year mine life in front of it. We recognize that the biggest opportunity for value creation is likely to come from our existing asset base. However, all options must be on the table. Acquisitions, divestments, mergers, partnerships, and joint ventures, all looked at through the lens of whether they will improve the overall quality of our portfolio and at the same time deliver value to our shareholders. Since the last Diggers and Dealers conference, we have completed 2 major transactions that have delivered against this objective. We divested Pajingo, our shortest mine life asset, and we acquired an economic interest in Ernest Henry that will provide very low cost production for more than a decade. I have said before that improving the quality of our portfolio is the religion at Evolution. Other than that, I do assure you we are non-denominational. The other thing we have tried to ensure is that in each transaction we have undertaken, we've been able to articulate the value we bring to the transaction. Money alone is not a good enough answer to this question because anyone can bring it. Unless you can articulate and be confident of the value you can add, and it is not always clear-cut, you do run the very real risk of destroying shareholder value. Hoping that the market has not understood the value of a company and that you can add a 30 to 40% premium for a takeover and still generate value for your shareholders has been a dangerous strategy and a path we have deliberately chosen not to go down. To give you a sense of our approach, I want to focus on our 3 best examples of this. The value add in transforming Mount Carlton into a very important asset in our portfolio was largely based on our experience in China, enabling us to secure an offtake party for what was previously considered unmarketable and unsaleable concentrate. The mine was commissioned in the middle of 2013, and in the last 2 financial years has delivered net mine cash flow of $103 million and $91 million, respectively. The mine has fully repaid all capital and development invested in its construction, and it still has an 8-year mine life ahead of it, and with exciting exploration upside. Turning to Cowal, a few weeks before we submitted the final binding offer for this asset, I asked a senior lawyer who was acting for Barrick what our chances of securing this coveted asset were. Bearing in mind that during the sale process, Evolution's market capitalization was below Barrick's asking price for the asset, it was a pretty fair assessment when he responded by saying, "Jake, if you secure this asset, you'll be the Stephen Bradbury of gold mining." So, in the tradition of Stephen Bradbury, who became the proud owner of a Winter Olympic gold medal, when all the leading competitors fell over before him with the finish line in sight, so too is Evolution now the proud owner of the Cowal gold mine. And what a transformational asset it has been for us. In the 24 months we have owned Cowal, it has produced 501,000 low-cost ounces. It has generated $322 million of net mine cash flow, or 47% of the purchase price. At the same time, an investment of just over $22 million in resource definition drilling has doubled the reserve base from 1.6 to 3.2 million ounces at a cost of only $14 per ounce, and we now have a mine life of at least 15 years ahead of us. A key driver to all our business development is to seek out situations where our interests with the counterparty we are engaging with are complementary rather than competing. In Glencore, we found such a counterparty when it was seeking to deleverage. Gold was not considered a core commodity of Glencore, and we were seeking to add long-life, low-cost ounces to our portfolio. In the recent June quarter, our interest in the Ernest Henry mine produced almost 24,000 ounces at an all-in sustaining cost of negative $432 per ounce and generated net mine cash flow of just under $48 million. We expect this will annualize to a rate of approximately $150 to $160 million a year for the current 11-year reserve life, and there is real potential to extend the mine life at depth materially. Overall, I'd say this slide largely speaks for itself. In the last 2 years alone, we have generated $1.3 billion of operating cash flow, $890 million of net mine cash flow. We've repaid $647 million of debt, paid $92 million to shareholders in dividends, and have a portfolio that generates an EBITDA margin of close to 50% for every ounce we produce. Whilst we continue to search for our next Cal or Ernest Henry, given the strength of the sector, I think the reality is that we are unlikely to find motivated sellers of assets like we did with Barrick and Glencore. In our view, the winners in this part of the cycle will be those who can demonstrate their discipline, not allow their margins to erode, grow organically, and continue to generate significant amounts of cash flow. Importantly, this discipline and cash flow needs to be delivered to shareholders through dividends rather than through the promises of riches tomorrow. The other way we believe you can add value to shareholders is through discovery. And here are some of our thoughts on this important part of our business. If you ask any gold company whether they consider discovery to be a core part of their strategy, I suspect you'll get an unequivocal response that it is. But again, success in this area has been elusive, and unfortunately the evidence suggests, like in the area of M&A, it has largely been a value-destructive activity. Internally, we describe it as the discovery paradox. If you consider that the average time to take a deposit from a greenfield discovery to production is, in an optimistic case, 10 to 15 years, it means that, and you've got to assume that the company is going to be around for that period of time, 10 to 15 years, that a commitment to funding a discovery strategy will require the support of 2, maybe 3 chairpersons of the company, probably 2 or 3 CEOs, and will also need to be resilient to the inevitable volatility of the gold price cycle. Unfortunately, there seems to be an absolute consistency of behavior that when the going gets tough, discovery spend is almost always considered discretionary and therefore one of the first things that is cut. I guess the key takeaway I'm trying to get across is that if you're not genuinely committed and funded for the long term, you're better off not starting. And if you do commit, you need to be sure you're looking for the right thing. In the 14 years between 1997 and 2011, there were 60 gold discoveries exceeding 2 million ounces globally. These new discoveries accounted for approximately 500 million ounces of gold or copper gold inventory. Interestingly, close to half of these ounces were in the much sought-after porphyry style of mineralization. But the harsh economic reality is that only one of these porphyry discoveries made it into commercial production, and that is Rio's Oyu Tolgoi mine, copper gold mine in Mongolia. In defining our strategy for discovery, we are very clear on what it is we want to find. Principally, we're looking for orogenic, lode, or epithermal style deposits. We also recognize that partnering with groups who may have superior geological knowledge of a specific area may be mutually beneficial. So we are definitely open for business in this area, as reflected in our recent joint venture with Terramin in South Australia's Gawler Craton and our cornerstone investment in the upcoming Rivers Gold IPO. We know that discovery requires a long-term commitment, and we are up for that challenge. We also recognize that the more we can demonstrate the sustainability of our low-cost production through reserve growth that results in mine life extensions, the more interest we will get from investors who are weighting their portfolios to high-quality, profitable, dividend-paying gold companies like Evolution. That is why we are particularly pleased that over the last 2 years, our reserves have increased from 2.2 million ounces to 7 million ounces, which has significantly contributed to our average mine life of our portfolio increasing from just over 5 years to now being over 8 years. The quality of those reserves is also critically important and is the reason why we continue to calculate our reserves on a conservative gold price of 1,350 Australian dollars per ounce as a safeguard to ensure we don't fall back into the trap which the gold industry has fallen into so many times before of pursuing growth for growth's sake, but we maintain our focus on margins and returns. One of the great aspects of travelling to Kalgoorlie for this event is the opportunity it gives us to showcase the Mungari operation we acquired 2 years ago from La Mancha. Tomorrow morning we will be hosting a large group of analysts and investors who will hear more about the very encouraging exploration results we are now generating in this rich gold belt. Evolution controls a significant land position, I think 950 square kilometres, and our discovery team is starting to unlock the geological potential of the area. And you can see, you can see on this slide, and you will see tomorrow when we release another presentation, the results we're starting to get. Mungari is allocated the largest portion of our discovery budget because we believe in the prospectivity of the area, and it is really a case of watch this space. So finally, in wrapping up, here's a summary of what I believe and our team believes longer-term success looks like for us at Evolution. We want to be known as a company that is good for your career if you're working at Evolution. That working for Evolution has allowed every person who wears that shirt to grow personally and professionally, and that the rest of the industry recognizes it. We want our people to go home safely to their families and to move to a safety culture where people do the right thing for themselves and those around them because they believe in it rather than because there is a rule in place. We think whilst input costs have largely bottomed, there is still significant potential to make gains through improved productivity and efficiency and finding innovative ways of doing things better. And we want to be developing an ore body that we have discovered even better if it is within sight of one of our mills. I hope I've been able to convey to you our very strong conviction and sense of purpose. Ultimately, it really boils down to a commitment to continue to work towards our vision of inspired people creating Australia's premier gold company. Thank you.
Thank you, Jake. I think we have time for just a couple questions. We've got one down here, if the mic can.
It's all right.
The only thing I know is that it wasn't a phone call from you. Jake, Evolution is very much an Australian company. Have you thought about looking offshore, or do you just see that there's more potential just here at home, or are there some countries you would be attracted to? Second question, your exercise in New Zealand, the greenies over there have claimed that you've left. Are you going to consider another shot?
I'll answer the second question first because it's easier. We drilled the program which we wanted to drill. We didn't get quite the results we wanted, so we're in the process of making a decision on that asset. But it didn't deliver what we were expecting from the first round of exploration. When it comes to other jurisdictions, I always have to remind myself how easy Australia is relative to our experience in China. But, yes, we are open to other jurisdictions. Looked at through the lens of, does it improve the quality of the portfolio? Can we really add value to the opportunity? Asia's interesting, but high risk. It feels a little bit like risk is rising for miners in that region. But for the right geological opportunity, yes, we would consider it. Would we bet the farm on it? No. South America and Africa, really, we just struggle to see what value we're going to deliver to that opportunity. So, yes, we are always open. We did not try and have a paradigm for what an ideal acquisition looks like. You've seen us do some hopefully innovative things when it comes to acquisitions and structures. The only caveat is improve the quality of the portfolio and really add value to our shareholders.
Other questions?
Everyone's thirsty.
Everyone's thirsty. Okay, thanks very much, Jake. Appreciate it.